Expeditors had no long-term debt, and its working capital had nearly doubled since 1995. According to Value Line, Expeditors' book value per share had increased 129%, and its return on capital had risen by more than one-third to 21%. By any standard, Expeditors was a superb business. But the little freight forwarding company, with its base in Seattle and much of its operations in Asia, was all but unknown on Wall Street. Only 32% of the shares were owned by institutional investors. In fact, Expeditors had only 8,500 shareholders. After doubling in 1999, the stock was priced at 39 times the net income Expeditors would earn for the year. No longer anywhere near cheap, but well below the vertiginous valuation of EMC. The Promised Land? By the end of 1999, Exodus Communications seemed to have taken its shareholders straight to the land of milk and honey. The stock soared 1,005.8% in 1999, enough to turn a $10,000 investment on January 1st into more than $110,000 by December 31st. Wall Street's leading internet stock analysts, including the hugely influential Henry Blodgett of Merrill Lynch, were predicting that the stock would rise another 25% to 125% over the coming year. And best of all, in the eyes of the online traders who gorged on Exodus's gains, was the fact that the stock had split 2-for-1 3 times during 1999. In a 2-for-1 stock split, a company doubles the number of its shares and halves their price. So a shareholder ends up owning twice as many shares, each priced at half the former level. What's so great about that? Imagine that you handed me a dime, and I then gave you back 2 nickels and asked, "Don't you feel richer now?" You would probably conclude either that I was an idiot or that I had mistaken you for one. And yet, in 1999's frenzy over dot-com stocks, online traders acted exactly as if 2 nickels were more valuable than 1 dime. In fact, just the news that a stock would be splitting 2-for-1 could instantly drive its shares up 20% or more. Why? Because getting more shares makes people feel richer. Someone who bought 100 shares of Exodus in January watched them turn into 200 when the stock split in April. Then those 200 turned into 400 in August. Then the 400 became 800 in December. It was thrilling for these people to realize that they had gotten 700 more shares just for owning 100 in the first place. To them, that felt like found money, never mind that the price per share had been cut in half with each split. In December 1999, one elated Exodus shareholder, who went by the handle "Gimme a Dollar," exulted on an online message board, "I'm going to hold these shares until I'm 80, because after it splits hundreds of times over the next years, I'll be close to becoming CEO." What about Exodus the business? Graham wouldn't have touched it with a 10-foot pole and a hazmat suit. Exodus's revenues were exploding, growing from $52.7 million in 1998 to $242.1 million in 1999. But it lost $130.3 million on those revenues in 1999, nearly double its loss the year before. Exodus had $2.6 billion in total debt, and was so starved for cash that it borrowed $971 million in the month of December alone. According to Exodus's annual report, that new borrowing would add more than $50 million to its interest payments in the coming year. The company started 1999 with $156 million in cash, and even after raising $1.3 billion in new financing, finished the year with a cash balance of $1 billion, meaning that its businesses had devoured more than $400 million in cash during 1999. How could such a company ever pay its debts? But of course, online traders were fixated on how far and fast the stock had risen, not on whether the company was healthy. "This stock," bragged a trader using the screen name of Launchpad 1999, "will just continue climbing To infinity and beyond! The absurdity of Launchpad's prediction, "What is beyond infinity?" is the perfect reminder of one of Graham's classic warnings. Today's investor, Graham tells us, is so concerned with anticipating the future that he is already paying handsomely for it in advance. Thus, what he has projected with so much study and care may actually happen and still not bring him any profit. If it should fail to materialize to the degree expected, he may in fact be faced with a serious, temporary, and perhaps even permanent loss. Where the E's ended up. How did these four stocks perform after 1999? Emerson Electric went on to gain 40.7% in 2000, although the shares lost money in both 2001 and 2002. They nevertheless ended 2002 less than 4% below their final price of 1999. EMC also rose in 2000, gaining 21.7%. But then the shares lost 79.4% in 2001 and another 54.3% in 2002. That left them 88% below their level at year-end 1999. What about the forecast of $10 billion in revenues by 2001? EMC finished that year with revenues of just $7.1 billion and a net loss of $508 million. Meanwhile, as if the bear market did not even exist, Expeditors International shares went on to gain 22.9% in 2000, 6.5% in 2001, and another 15.1% in 2002, finishing that year nearly 51% higher than their price at the end of 1999. Exodus's stock lost 55% in 2000 and 99.8% in 2001. On September 26, 2001, Exodus filed for Chapter 11 bankruptcy protection. Most of the company's assets were bought by Cable and Wireless, the British telecommunications giant. Instead of delivering its shareholders to the promised land, Exodus left them exiled in the wilderness. As of early 2003, the last trade in Exodus's stock was at 1 penny a share. Chapter 14. Stock Selection for the Defensive Investor. It's time to turn to some broader applications of the techniques of security analysis. Since we've already described in general terms the investment policies recommended for our two categories of investors, it would be logical for us now to indicate how security analysis comes into play in order to implement these policies. The defensive investor who follows our suggestions will purchase only high-grade bonds, plus a diversified list of leading common stocks. He is to make sure that the price at which he bought the latter is not unduly high, as judged by applicable standards. In setting up this diversified list, he has a choice of two approaches: the DJIA type of portfolio and the quantitatively tested portfolio. In the first, he acquires a true cross-section sample of the leading issues, which will include both some favored growth companies whose shares sell at especially high multipliers, and also less popular and less expensive enterprises. This could be done, most simply perhaps, by buying the same amounts of all 30 of the issues in the Dow Jones Industrial Average, DJIA. 10 shares of each, at the 900 level for the average, would cost an aggregate of about $16,000. On the basis of the past record, he might expect approximately the same future results by buying shares of several representative investment funds. His second choice would be to apply a set of standards to each purchase, to make sure that he obtains 1. A minimum of quality in the past performance and current financial position of the company, and also 2. A minimum of quantity in terms of earnings and assets per dollar of price. At the close of the previous chapter, we listed 7 such quality and quantity criteria suggested for the selection of specific common stocks. Let us describe them in order. 1. Adequate size of the enterprise. All our minimum figures must be arbitrary, and especially in the matter of size required. Our idea is to exclude small companies which may be subject to more than average vicissitudes, especially in the industrial field. There are often good possibilities in such enterprises, but we do not consider them suited to the needs of the defensive investor. Let us use round amounts, not less than $100 million of annual sales for an industrial company, and not less than $50 million of total assets for a public utility. 2. A sufficiently strong financial condition. For industrial companies, current assets should be at least twice current liabilities, a so-called 2-to-1 current ratio. Also, long-term debt should not exceed the net current assets, or working capital. For public utilities, the debt should not exceed twice the stock equity, at book value. 3. Earnings stability. Some earnings for the common stock in each of the past 10 years. 4. Dividend record. Uninterrupted payments for at least the past 20 years. 5. Earnings growth. A minimum increase of at least 1/3 in per-share earnings in the past 10 years, using 3-year averages at the beginning and end. 6. Moderate price-to-earnings ratio. Current price should not be more than 15 times average earnings of the past 3 years. 7. Moderate ratio of price to assets. Current price should not be more than 1.5 times the book value last reported. However, a multiplier of earnings below 15 could justify a correspondingly higher multiplier of assets. As a rule of thumb, we suggest that the product of the multiplier times the ratio of price to book value should not exceed 22.5. This figure corresponds to 15 times earnings and 1.5 times book value. It would admit an issue selling at only 9 times earnings and 2.5 times asset value, etc. General comments. These requirements are set up especially for the needs and the temperament of defensive investors. They will eliminate the great majority of common stocks as candidates for the portfolio, and in 2 opposite ways. On the one hand, they will exclude companies that are 1. Too small, 2. In relatively weak financial condition, 3. With a deficit stigma in their 10-year record, and 4. Not having a long history of continuous dividends. Of these tests, the most severe under recent financial conditions are those of financial strength. A considerable number of our large and formerly strongly entrenched enterprises have weakened their current ratio, or overexpanded their debt, or both, in recent years. Our last 2 criteria are exclusive in the opposite direction. By demanding more earnings and more assets per dollar of price than the popular issues will supply. This is by no means the standard viewpoint of financial analysts. In fact, most will insist that even conservative investors should be prepared to pay generous prices for stocks of the choice companies. We have expounded our contrary view before. It rests largely on the absence of an adequate factor of safety when too large a portion of the price must depend on ever-increasing earnings in the future. The listener will have to decide this important question for himself, after weighing the arguments on both sides. We have nonetheless opted for the inclusion of a modest requirement of growth over the past decade. Without it, the typical company would show retrogression, at least in terms of profit per dollar of invested capital. There is no reason for the defensive investor to include such companies, though if the price is low enough, they could qualify as bargain opportunities. The suggested maximum figure of 15 times earnings might well result in a typical portfolio with an average multiplier of, say, 12 to 13 times. Note that in February 1972, American Tel sold at 11 times its 3-year and current earnings, and Standard Oil of California at less than 10 times latest earnings. Our basic recommendation is that the stock portfolio, when acquired, should have an overall earnings-to-price ratio, the reverse of the P/E ratio, at least as high as the current high-grade bond rate. This would mean a P/E ratio no higher than 13.3 against a AA bond yield of 7.5%. Application of our criteria to the DJIA at the end of 1970. All of our suggested criteria were satisfied by the DJIA issues at the end of 1970, but two of them just barely. Here is a survey based on the closing price of 1970 and the relevant figures. The basic data for each company are shown in tables 14.1 and 14.2, found on the enhancement. 1. Size is more than ample for each company. 2. Financial condition is adequate in the aggregate, but not for every company. 3. Some dividend has been paid by every company since at least 1940. 5 of the dividend records go back to the last century. 4. The aggregate earnings have been quite stable in the past decade. None of the companies reported a deficit during the prosperous period 1961 through 69, but Chrysler showed a small deficit in 1970. 5. The total growth, comparing 3-year averages a decade apart, was 77%, or about 6% per year. But 5 of the firms did not grow by 1/3. 6. The ratio of year-end price to 3-year average earnings was $839 to $55.50, or 15-1, right at our suggested upper limit. 7. The ratio of price to net asset value was $839 to $562, also just within our suggested limit of 1.5 to 1. If, however, we wish to apply the same 7 criteria to each individual company, we would find that only 5 of them would meet all our requirements. These would be American Can, American Tell, Anaconda, Swift, and Woolworth. The totals for these 5 appear in Table 14.3, which can be viewed on the enhancement. Naturally, they make a much better statistical showing than the DJIA as a whole, except in the past growth rate. Our application of specific criteria to this select group of industrial stocks indicates that the number meeting every one of our tests will be a relatively small percentage of all listed industrial issues. We hazard the guess that about 100 issues of this sort could have been found in the Standard & Poor's Stock Guide at the end of 1970, just about enough to provide the investor with a satisfactory range of personal choice. The Public Utility Solution. If we turn now to the field of public utility stocks, we find a much more comfortable and inviting situation for the investor. Here, the vast majority of issues appear to be cut out by their performance record and their price ratios in accordance with the defensive investor's needs as we judge them. We exclude one criterion from our tests of public utility stocks, namely the ratio of current assets to current liabilities. The working capital factor takes care of itself in this industry as part of the continuous financing of its growth by sales of bonds and shares. We do require an adequate proportion of stock capital to debt. In Table 14.4, we present a resume of the 15 issues in the Dow Jones Public Utility Average. For comparison, Table 14.5 gives a similar picture of a random selection of 15 other utilities taken from the New York Stock Exchange list. Both tables can be analyzed on the enhanced portion of this audiobook. As 1972 began, the defensive investor could have had quite a wide choice of utility common stocks, each of which would have met our requirements for both performance and price. These companies offered him everything he had a right to demand from simply chosen common stock investments. In comparison with prominent industrial companies as represented by the DJIA, they offered almost as good a record of past growth, plus smaller fluctuations in the annual figures, both at a lower price in relation to earnings and assets. The dividend return was significantly higher. The position of utilities as regulated monopolies is assuredly more of an advantage than a disadvantage for the conservative investor. Under law, they're entitled to charge rates sufficiently remunerative to attract the capital they need for their continuous expansion. and this implies adequate offsets to inflated costs. While the process of regulation has often been cumbersome and perhaps dilatory, it has not prevented the utilities from earning a fair return on their rising invested capital over many decades. For the defensive investor, the central appeal of the public utility stocks at this time should be their availability at a moderate price in relation to book value. This means that he can ignore stock market considerations, if he wishes, and consider himself primarily as a part owner of well-established and well-earning businesses. The market quotations are always there for him to take advantage of when times are propitious, either for purchases at unusually attractive low levels or for sales when their prices seem definitely too high. The market record of the public utility indexes, condensed in Table 14.6 and reproduced on the enhancement, along with those of other groups, indicates that there have been ample possibilities of profit in these investments in the past. While the rise has not been as great as in the industrial index, the individual utilities have shown more price stability in most periods than have other groups. It is striking to observe in this table that the relative price-to-earnings ratios of the industrials and the utilities have changed places during the past 2 decades. These reversals will have more meaning for the active than for the passive investor, but they suggest that even defensive portfolios should be changed from time to time, especially if the securities purchased have an apparently excessive advance and can be replaced by issues much more reasonably priced. Alas, there will be capital gains taxes to pay, which for the typical investor seems to be about the same as the devil to pay. Our old ally, experience, tells us here that it is better to sell and pay the tax than not sell and repent. Investing in stocks of financial enterprises. A considerable variety of concerns may be ranged under the rubric of financial companies. These would include banks, insurance companies, savings and loan associations, credit and small loan companies, mortgage companies, and investment companies, for example, mutual funds. It is characteristic of all these enterprises that they have a relatively small part of their assets in the form of material things, such as fixed assets and merchandise inventories. But on the other hand, most categories have short-term obligations well in excess of their stock capital. The question of financial soundness is therefore more relevant here than in the case of the typical manufacturing or commercial enterprise. This, in turn, has given rise to various forms of regulation and supervision, with the design and general result of assuring against unsound financial practices. Broadly speaking, the shares of financial concerns have produced investment results similar to those of other types of common shares. Table 14.7, which can be found on the enhancement, shows price changes between 1948 and 1970 in 6 groups represented in the Standard & Poor's stock price indexes. The average for 1941 through 1943 is taken as 10, the base level. The year-end 1970 figures ranged between 44.3 for the 9 New York banks and 218 for the 11 life insurance stocks. During the sub-intervals, there was considerable variation in the respective price movements. For example, the New York City bank stocks did quite well between 1958 and 1968. Conversely, the spectacular life insurance group actually lost ground between 1963 and 1968. These cross movements are found in many, perhaps most, of the numerous industry groups in the Standard & Poor's indexes. We have no very helpful remarks to offer in this broad area of investment, other than to counsel that the same arithmetical standards for price in relation to earnings and book value be applied to the choice of companies in these groups, as we have suggested for industrial and public utility investments. Railroad issues. The railroad story is a far different one from that of the utilities. The carriers have suffered severely from a combination of severe competition and strict regulation. Their labor cost problem has of course been difficult as well, but that has not been confined to railroads. Automobiles, buses, and airlines have drawn off most of their passenger business and left the rest highly unprofitable. The trucks have taken a good deal of their freight traffic. More than half of the railroad mileage of the country has been in bankruptcy or trusteeship at various times during the past 50 years. But this half-century has not been all downhill for the carriers. There have been prosperous periods for the industry, especially the war years. Some of the lines have managed to maintain their earning power and their dividends despite the general difficulties. The Standard & Poor's Index advanced sevenfold from the low of 1942 to the high of 1968, not much below the percentage gain in the Public Utility Index. The bankruptcy of the Penn Central Transportation Company, our most important railroad, in 1970, shocked the financial world. Only a year and 2 years previously, the stock sold at close to the highest price level in its long history, and it had paid continuous dividends for more than 120 years. Coming up, we will present a brief analysis of this railroad to illustrate how a competent student could have detected the developing weaknesses in the company's picture and counseled against ownership of its securities. The market level of railroad shares as a whole was seriously affected by this financial disaster. It is usually unsound to make blanket recommendations of whole classes of securities, and there are equal objections to broad condemnations. The record of railroad share prices in Table 14.6, found on the enhancement, shows that the group as a whole has often offered chances for a large profit. But in our view, the great advances were in themselves largely unwarranted. Let us confine our suggestion to this. There is no compelling reason for the investor to own railroad shares. Before he buys any, he should make sure that he's getting so much value for his money that it would be unreasonable to look for something else instead. Selectivity for the defensive investor. Every investor would like his list to be better or more promising than the average. Hence, the listener will ask whether, if he gets himself a competent advisor or security analyst, he should not be able to count on being supplied with an investment package of really superior merits. After all, he may say, the rules you've outlined are pretty simple and easygoing. A highly trained analyst ought to be able to use all his skill and techniques to improve substantially on something as obvious as the Dow Jones list. If not, what good are all his statistics, calculations, and pontifical judgments? Suppose, as a practical test, we had asked 100 security analysts to choose the best 5 stocks in the Dow Jones average, to be bought at the end of 1970. Few would have come up with identical choices, and many of the lists would have differed completely from each other. This is not so surprising as it may at first appear. The underlying reason is that the current price of each prominent stock pretty well reflects the salient factors in its financial record, plus the general opinion as to its future prospects. Hence, the view of any analyst that one stock is a better buy than the rest must arise to a great extent from his personal partialities and expectations, or from the placing of his emphasis on one set of factors rather than on another in his work of evaluation. If all analysts were agreed that one particular stock was better than all the rest, that issue would quickly advance to a price which would offset all of its previous advantages. Our statement that the current price reflects both known facts and future expectations was intended to emphasize the double basis for market valuations. Corresponding with these two kinds of value elements are two basically different approaches to security analysis. To be sure, every competent analyst looks forward to the future rather than backward to the past, and he realizes that his work will prove good or bad depending on what will happen and not on what has happened. Nevertheless, the future itself can be approached in two different ways, which may be called the way of prediction or projection, and the way of protection. Those who emphasize prediction will endeavor to anticipate fairly accurately just what the company will accomplish in future years, in particular whether earnings will show pronounced and persistent growth. These conclusions may be based on a very careful study of such factors as supply and demand in the industry, or volume, price, and costs, or else they may be derived from a rather naive projection of the line of past growth into the future. If these authorities are convinced that the fairly long-term prospects are unusually favorable, they will almost always recommend the stock for purchase without paying too much regard to the level at which it is selling. Such, for example, was the general attitude with respect to the air transport stocks, an attitude that persisted for many years despite the distressingly bad results often shown after 1946. In the introduction, we've commented on the disparity between the strong price action and the relatively disappointing earnings record of this industry. By contrast, those who emphasize protection are always especially concerned with the price of the issue at the time of study. Their main effort is to assure themselves of a substantial margin of indicated present value above the market price, which margin could absorb unfavorable developments in the future. Generally speaking, therefore, it is not so necessary for them to be enthusiastic over the company's long-run prospects, as it is to be reasonably confident that the enterprise will get along. The first, or predictive approach, could also be called the qualitative approach, since it emphasizes prospects, management, and other non-measurable, albeit highly important factors that go under the heading of quality. The second, or protective approach, may be called the quantitative or statistical approach, since it emphasizes the measurable relationships between selling price and earnings, assets, dividends, and so forth. Incidentally, the quantitative method is really an extension into the field of common stocks, of the viewpoint that security analysis has found to be sound in the selection of bonds and preferred stocks for investment. In our own attitude and professional work, we were always committed to the quantitative approach. From the first, we wanted to make sure that we were getting ample value for our money in concrete, demonstrable terms. We were not willing to accept the prospects and promises of the future as compensation for a lack of sufficient value in hand. This has by no means been the standard viewpoint among investment authorities. In fact, the majority would probably subscribe to the view that prospects, quality of management, other intangibles, and the human factor far outweigh the indications supplied by any study of the past record, the balance sheet, and all the other cold figures. Thus, this matter of choosing the best stocks is at bottom a highly controversial one. Our advice to the defensive investor is that he let it alone. Let him emphasize diversification more than individual selection. Incidentally, the universally accepted idea of diversification is, in part at least, the negation of the ambitious pretensions of selectivity. If one could select the best stocks unerringly, one would only lose by diversifying. Yet within the limits of the four most general rules of common stock selection suggested for the defensive investor, there is room for a rather considerable freedom of preference. At the worst, the indulgence of such preferences should do no harm. Beyond that, it may add something worthwhile to the results. With the increasing impact of technological developments on long-term corporate results, the investor cannot leave them out of his calculations. Here, as elsewhere, he must seek a mean between neglect and overemphasis. Commentary on Chapter 14. He that resteth upon gain certain shall hardly grow to great riches, and he that puts all upon adventures doth oftentimes break and come to poverty. It is good, therefore, to guard adventures with certainties that may uphold losses. Sir Francis Bacon. Getting started. How should you tackle the nitty-gritty work of stock selection? Graham suggests that the defensive investor can, most simply, buy every stock in the Dow Jones Industrial Average. Today's defensive investor can do even better. By buying a total stock market index fund that holds essentially every stock worth having. A low-cost index fund is the best tool ever created for low-maintenance stock investing, and any effort to improve on it takes more work and incurs more risk and higher costs than a truly defensive investor can justify. Researching and selecting your own stocks is not necessary. For most people, it's not even advisable. However, some defensive investors do enjoy the diversion and intellectual challenge of picking individual stocks. And if you've survived a bear market and still enjoy stock picking, then nothing that Graham or I could say will dissuade you. In that case, instead of making a total stock market index fund your complete portfolio, make it the foundation of your portfolio. Once you have that foundation in place, you can experiment around the edges with your own stock choices. Keep 90% of your stock money in an index fund, leaving 10% with which to try picking your own stocks. Only after you build that solid core should you explore. Why diversify? During the bull market of the 1990s, one of the most common criticisms of diversification was that it lowers your potential for high returns. After all, if you could identify the next Microsoft, wouldn't it make sense for you to put all your eggs into that one basket? Well, sure. As the humorist Will Rogers once said, "Don't gamble. Take all your savings and buy some good stock and hold it till it goes up. Then sell it. If it don't go up, don't buy it." However, as Rogers knew, 20/20 foresight is not a gift granted to most investors. No matter how confident we feel, there's no way to find out whether a stock will go up until after we buy it. Therefore, the stock you think is the next Microsoft may well turn out to be the next MicroStrategy instead. That former market star went from $3,130 per share in March 2000 to $15.10 at year-end 2002, an apocalyptic loss of 99.5%. Keeping your money spread across many stocks and industries is the only reliable insurance against the risk of being wrong. But diversification doesn't just minimize your odds of being wrong, it also maximizes your chances of being right. Over long periods of time, a handful of stocks turn into super stocks that go up 10,000% or more. Money Magazine identified the 30 best-performing stocks over the 30 years ending in 2002. And even with 20/20 hindsight, the list is startlingly unpredictable. Rather than lots of technology or healthcare stocks, it includes Southwest Airlines, Worthington Steel, Dollar General discount stores, and snuff tobacco maker UST Incorporated. If you think you would have been willing to bet big on any of those stocks back in 1972, you are kidding yourself. Think of it this way. In the huge market haystack, only a few needles ever go on to generate truly gigantic gains. The more of the haystack you own, the higher the odds go that you will end up finding at least one of those needles. By owning the entire haystack, ideally through an index fund that tracks the total U.S. stock market, you can be sure to find every needle, thus capturing the returns of all the super stocks. Especially if you are a defensive investor, why look for the needles when you can own the whole haystack? Testing. Let's briefly update Graham's criteria for stock selection. Adequate size. Nowadays, to exclude small companies, most defensive investors should steer clear of stocks with a total market value of less than $2 billion. In early 2003, that still left you with 437 of the companies in the Standard & Poor's 500 stock index to choose from. However, today's defensive investors, unlike those in Graham's day, can conveniently own small companies by buying a mutual fund specializing in small stocks. Again, an index fund like Vanguard Small Cap Index is the first choice, although active funds are available at reasonable cost from such firms as Ariel, T. Rowe Price, Royce, and Third Avenue. Strong financial condition. According to market strategists Steve Galbraith and Jay Lassis of Morgan Stanley, at the beginning of 2003, about 120 of the companies in the S&P 500 index met Graham's test of a 2-to-1 current ratio. With current assets at least twice their current liabilities, these firms had a sizable cushion of working capital that on average should sustain them through hard times. Wall Street has always abounded in bitter ironies, and the bursting of the growth stock bubble has created a doozy. In 1999 and 2000, high-tech, biotech, and telecommunications stocks were supposed to provide aggressive growth, and ended up giving most of their investors aggressive shrinkage instead. But by early 2003, the wheel had come full circle, and many of those aggressive growth stocks had become financially conservative, loaded with working capital, rich in cash, and often debt-free. This table provides a sampler. It can be found on the enhancement. The lesson here is not that these stocks were a sure thing, or that you should rush out and buy everything or anything in this table. Instead, you should realize that a defensive investor can always prosper by looking patiently and calmly through the wreckage of a bear market. Graham's criterion of financial strength still works. If you build a diversified basket of stocks whose current assets are at least double their current liabilities and whose long-term debt does not exceed working capital, you should end up with a group of conservatively financed companies with plenty of staying power. The best values today are often found in the stocks that were once hot and have since gone cold. Throughout history, such stocks have often provided the margin of safety that a defensive investor demands. Earnings stability. According to Morgan Stanley, 86% of all the companies in the S&P 500 index have had positive earnings in every year from 1993 through 2002. So Graham's insistence on some earnings for the common stock in each of the past 10 years remains a valid test, tough enough to eliminate chronic losers, but not so restrictive as to limit your choices to an unrealistically small sample. Dividend record. As of early 2003, according to Standard & Poor's, 354 companies in the S&P 500, or 71% of the total, paid a dividend. No fewer than 255 companies have paid a dividend for at least 20 years in a row. And according to S&P, 57 companies in the index have raised their dividends for at least 25 consecutive years. That's no guarantee that they will do so forever, but it's a comforting sign. Earnings growth. How many companies in the S&P 500 increased their earnings per share by at least 1/3, as Graham requires, over the 10 years ending in 2002? We'll average each company's earnings from 1991 through 1993, and then determine whether the average earnings from 2000 through 2002 were at least 33% higher. According to Morgan Stanley, 264 companies in the S&P 500 met that test. But here it seems Graham set a very low hurdle. 33% cumulative growth over a decade is less than a 3% average annual increase. Cumulative growth in earnings per share of at least 50%, or a 4% average annual rise, is a bit less conservative. No fewer than 245 companies in the S&P 500 index met that criterion as of early 2003, leaving the defensive investor an ample list to choose from. If you double the cumulative growth hurdle to 100%, or 7% average annual growth, then 198 companies make the cutoff. Moderate P/E ratio. Graham recommends limiting yourself to stocks whose current price is no more than 15 times average earnings over the past 3 years. Incredibly, the prevailing practice on Wall Street today is to value stocks by dividing their current price by something called next year's earnings. That gives what is sometimes called the forward P/E ratio. But it's nonsensical to derive a price-to-earnings ratio by dividing the known current price by unknown future earnings. Over the long run, money manager David Dreman has shown 59% of Wall Street's consensus earnings forecasts miss the mark by a mortifyingly wide margin, either underestimating or overestimating the actual reported earnings by at least 15%. Investing your money on the basis of what these myopic soothsayers predict for the coming year is as risky as volunteering to hold up the bullseye at an archery tournament for the legally blind. Instead, calculate a stock's price-to-earnings ratio yourself, using Graham's formula of current price divided by average earnings over the past 3 years. As of early 2003, how many stocks in the Standard & Poor's 500 index were valued at no more than 15 times their average earnings of 2000 through 2002? According to Morgan Stanley, a generous total of 185 companies passed Graham's test. Moderate price-to-book ratio. Graham recommends a ratio of price to assets, or price-to-book value ratio, of no more than 1.5. In recent years, an increasing proportion of the value of companies has come from intangible assets like franchises, brand names, and patents and trademarks. Since these factors, along with goodwill from acquisitions, are excluded from the standard definition of book value, most companies today are priced at higher price-to-book multiples than in Graham's day. According to Morgan Stanley, 123 of the companies in the S&P 500, or 1 in 4, are priced below 1.5 times book value. All told, 273 companies, or 55% of the index, have price-to-book ratios of less than 2.5. What about Graham's suggestion that you multiply the P/E ratio by the price-to-book ratio and see whether the resulting number is below 22.5? Based on data from Morgan Stanley, at least 142 stocks in the S&P 500 could pass that test as of early 2003, including Dana Corporation, Electronic Data Systems, Sun Microsystems, and Washington Mutual. So Graham's blended multiplier still works as an initial screen to identify reasonably priced stocks. Due diligence. No matter how defensive an investor you are, in Graham's sense of wishing to minimize the work you put into picking stocks, there are a couple of steps you cannot afford to skip. Do your homework. Through the Edgar database at www.sec.gov, you get instant access to a company's annual and quarterly reports, along with the proxy statement that discloses the manager's compensation, ownership, and potential conflicts of interest. Read at least 5 years' worth. Check out the neighborhood. Websites like http://quicktake.morningstar.com, http://finance.yahoo.com, and www.quicken.com can readily tell you what percentage of a company's shares are owned by institutions. Anything over 60% suggests that a stock is scarcely undiscovered and probably overowned. When big institutions sell, they tend to move in lockstep, with disastrous results for the stock. Imagine all the Radio City Rockettes toppling off the front edge of the stage at once, and you get the idea. Those websites will also tell you who the largest owners of the stock are. If they're money management firms that invest in a style similar to your own, that's a good sign. Chapter 15. Stock Selection for the Enterprising Investor. In the previous chapter, we have dealt with common stock selection in terms of broad groups of eligible securities, from which the defensive investor is free to make up any list that he or his advisor prefers, provided adequate diversification is achieved. Our emphasis in selection has been chiefly on exclusions, advising on the one hand against all issues of recognizably poor quality, and on the other against the highest quality issues if their price is so high as to involve a considerable speculative risk. In this chapter addressed to the enterprising investor, we must consider the possibilities and the means of making individual selections, which are likely to prove more profitable than an across-the-board average. What are the prospects of doing this successfully? We would be less than frank, as the euphemism goes, if we did not at the outset express some grave reservations on this score. At first blush, the case for successful selection appears self-evident. To get average results, for example equivalent to the performance of the DJIA, should require no special ability of any kind. All that is needed is a portfolio identical with or similar to those 30 prominent issues. Surely then, by the exercise of even a moderate degree of skill, derived from study, experience, and native ability, it should be possible to obtain substantially better results than the DJIA. Yet there is considerable and impressive evidence to the effect that this is very hard to do, even though the qualifications of those trying it are of the highest. The evidence lies in the record of the numerous investment companies, or funds, which have been in operation for many years. Most of these funds are large enough to command the services of the best financial or security analysts in the field, together with all the other constituents of an adequate research department. Their expenses of operation, when spread over their ample capital, average about 0.5% a year thereon, or less. These costs are not negligible in themselves, but when they're compared with the approximately 15% annual overall return on common stocks generally in the decade 1951 through 1960, and even the 6% return in 1961 through 1970, they do not bulk large. A small amount of superior selective ability should easily have overcome that expense handicap and brought in a superior net result for the fund shareholders. Taken as a whole, however, the all-common stock funds failed over a long span of years to earn quite as good a return as was shown on Standard & Poor's 500 stock averages, or the market as a whole. This conclusion has been substantiated by several comprehensive studies. To quote the latest one before us, covering the period 1960 through 1968. It appears from these results that random portfolios of New York Stock Exchange stocks, with equal investment in each stock, performed on the average better over the period than did mutual funds in the same risk class. The differences were fairly substantial for the low and medium risk portfolios, 3.7% and 2.5% respectively per annum, but quite small for the high-risk portfolios, 0.2% per annum. As we pointed out in Chapter 9, these comparative figures in no way invalidate the usefulness of the investment funds as a financial institution, for they do make available to all members of the investing public the possibility of obtaining approximately average results on their common stock commitments. For a variety of reasons, most members of the public who put their money in common stocks of their own choice fail to do nearly as well. But to the objective observer, the failure of the funds to better the performance of a broad average is a pretty conclusive indication that such an achievement, instead of being easy, is in fact extremely difficult. Why should this be so? We can think of two different explanations, each of which may be partially applicable. The first is the possibility that the stock market does in fact reflect in the current prices not only all the important facts about the company's past and current performance, but also whatever expectations can be reasonably formed as to their future. If this is so, then the diverse market movements which subsequently take place, and these are often extreme, must be the result of new developments and probabilities that could not be reliably foreseen. This would make the price movements essentially fortuitous and random. To the extent that the foregoing is true, the work of the security analyst, however intelligent and thorough, must be largely ineffective, because in essence he is trying to predict the unpredictable. The very multiplication of the number of security analysts may have played an important part in bringing about this result. With hundreds, even thousands of experts studying the value factors behind an important common stock, it would be natural to expect that its current price would reflect pretty well the consensus of informed opinion on its value. Those who would prefer it to other issues would do so for reasons of personal partiality or optimism that could just as well be wrong as right. We have often thought of the analogy between the work of the host of security analysts on Wall Street and the performance of master bridge players at a duplicate bridge tournament. The former try to pick the stocks most likely to succeed, the latter to get top score for each hand played. Only a limited few can accomplish either aim. To the extent that all the bridge players have about the same level of expertness, the winners are likely to be determined by breaks of various sorts, rather than superior skill. On Wall Street, the leveling process is helped along by the freemasonry that exists in the profession, under which ideas and discoveries are quite freely shared at the numerous get-togethers of various sorts. It is almost as if, at the analogous bridge tournament, the various experts were looking over each other's shoulders and arguing out each hand as it was played. The second possibility is of a quite different sort. Perhaps many of the security analysts are handicapped by a flaw in their basic approach to the problem of stock selection. They seek the industries with the best prospects of growth, and the companies in these industries with the best management and other advantages. The implication is that they will buy into such industries and such companies at any price, however high, and they will avoid less promising industries and companies no matter how low the price of their shares. This would be the only correct procedure if the earnings of the good companies were sure to grow at a rapid rate indefinitely in the future, for then, in theory, their value would be infinite. And if the less promising companies were headed for extinction with no salvage, the analysts would be right to consider them unattractive at any price. The truth about our corporate ventures is quite otherwise. Extremely few companies have been able to show a high rate of uninterrupted growth for long periods of time. Remarkably few, also, of the larger companies suffer ultimate extinction. For most, their history is one of vicissitudes, of ups and downs, of change in their relative standing. In some, the variations from rags to riches and back have been repeated on almost a cyclical basis. The phrase used to be a standard one applied to the steel industry. For others, spectacular changes have been identified with deterioration or improvement of management. How does the foregoing inquiry apply to the enterprising investor who would like to make individual selections that will yield superior results? It suggests, first of all, that he is taking on a difficult and perhaps impracticable assignment. Listeners of this audiobook, however intelligent and knowing, could scarcely expect to do a better job of portfolio selection than the top analysts of the country. But if it is true that a fairly large segment of the stock market is often discriminated against or entirely neglected in the standard analytical selections, then the intelligent investor may be in a position to profit from the resultant undervaluations. But to do so, he must follow specific methods that are not generally accepted on Wall Street, since those that are so accepted do not seem to produce the results everyone would like them to achieve. It would be rather strange if, with all the brains at work professionally in the stock market, there could be approaches which are both sound and relatively unpopular. Yet our own career and reputation have been based on this unlikely fact. A summary of the Graham-Newman methods. To give concreteness to the last statement, it should be worthwhile to give a brief account of the types of operations we engaged in during the 30-year life of Graham-Newman Corporation between 1926 and 1956. These were classified in our records as follows. Arbitrages. The purchase of a security and the simultaneous sale of one or more other securities into which it was to be exchanged under a plan of reorganization, merger, or the like. Liquidations. purchase of shares which were to receive one or more cash payments in liquidation of the company's assets. Operations of these two classes were selected on the twin basis of A, a calculated annual return of 20% or more, and B, our judgment that the chance of a successful outcome was at least 4 out of 5. Related hedges. The purchase of convertible bonds or convertible preferred shares, and the simultaneous sale of the common stock into which they were exchangeable. The position was established at close to a parity basis, for example at a small maximum loss if the senior issue had actually to be converted and the operation closed out in that way. But a profit would be made if the common stock fell considerably more than the senior issue, and the position closed out in the market. Net current asset or bargain issues. The idea here was to acquire as many issues as possible at a cost for each of less than their book value in terms of net current assets alone. For example, giving no value to the plant account and other assets. Our purchases were made typically at 2/3 or less of such stripped-down asset value. In most years, we carried a wide diversification here, at least 100 different issues. We should add that from time to time we had some large-scale acquisitions of the control type, but these are not relevant to the present discussion. We kept close track on the results shown by each class of operation. In consequence of these follow-ups, we discontinued 2 broader fields, which were found not to have shown satisfactory overall results. The first was the purchase of apparently attractive issues based on our general analysis, which were not obtainable at less than their working capital value alone. The second were unrelated hedging operations, in which the purchased security was not exchangeable for the common shares sold. Such operations correspond roughly to those recently embarked on by the new group of hedge funds in the investment company field. In both cases, a study of the results realized by us over a period of 10 years or more led us to conclude that the profits were not sufficiently dependable and the operations not sufficiently headache-proof to justify our continuing them. Hence, from 1939 on, our operations were limited to self-liquidating situations, related hedges, working capital bargains, and a few control operations. Each of these classes gave us quite consistently satisfactory results from then on, with the special feature that the related hedges turned in good profits in the bear markets, when our undervalued issues were not doing so well. We hesitate to prescribe our own diet for any large number of intelligent investors. Obviously, the professional techniques we have followed are not suitable for the defensive investor, who by definition is an amateur. As for the aggressive investor, perhaps only a small minority of them would have the type of temperament needed to limit themselves so severely to only a relatively small part of the world of securities. Most active-minded practitioners would prefer to venture into wider channels. Their natural hunting grounds would be the entire field of securities that they felt A, were certainly not overvalued by conservative measures, and B, appeared decidedly more attractive because of their prospects or past record, or both, than the average common stock. In such choices, they would do well to apply various tests of quality and price reasonableness along the lines we have proposed for the defensive investor. But they should be less inflexible, permitting a considerable plus in one factor to offset a small black mark in another. For example, he might not rule out a company which had shown a deficit in a year such as 1970, if large average earnings and other important attributes made the stock look cheap. The enterprising investor may confine his choice to industries and companies about which he holds an optimistic view. But we counsel strongly against paying a high price for a stock in relation to earnings and assets because of such enthusiasm. If he followed our philosophy in this field, he would more likely be the buyer of important cyclical enterprises, such as steel shares, perhaps, when the current situation is unfavorable, the near-term prospects are poor, and the low price fully reflects the current pessimism. Secondary companies. Next, in order for examination and possible selection, would come secondary companies that are making a good showing, have a satisfactory past record, but appear to hold no charm for the public. These would be enterprises on the order of Eltra and Emhart at their 1970 closing prices. There are various ways of going about locating such companies. We should like to try a novel approach here and give a reasonably detailed exposition of one such exercise in stock selection. Ours is a double purpose. Many of our listeners may find a substantial practical value in the method we shall follow, or it may suggest comparable methods to try out. Beyond that, what we shall do may help them come to grips with the real world of common stocks, and introduce them to one of the most fascinating and valuable little volumes in existence. It is Standard & Poor's Stock Guide, published monthly and made available to the general public under annual subscription. In addition, many brokerage firms distribute the guide to their clients on request. The great bulk of the guide is given over to about 230 pages of condensed statistical information on the stocks of more than 4,500 companies. These include all the issues listed on the various exchanges, say 3,000 plus some 1,500 unlisted issues. Most of the items needed for a first and even a second look at a given company appear in this compendium. From our viewpoint, the important missing datum is the net asset value, or book value per share, which can be found in the larger Standard & Poor's volumes and elsewhere. The investor who likes to play around with corporate figures will find himself in clover with the stock guide. He can open to any page and see before his eyes a condensed panorama of the splendors and miseries of the stock market, with all-time high and low prices going as far back as 1936 when available. He will find companies that have multiplied their price 2,000 times from the minuscule low to the majestic high. For prestigious IBM, the growth was only 333 times in that period. He will find, not so exceptionally, a company whose shares advanced from 3/8 to 68, and then fell back to 3. In the dividend record column, he will find one that goes back to 1791, paid by Industrial National Bank of Rhode Island, which recently saw fit to change its ancient corporate name. If he looks at the guide for the year-end 1969, he'll read that Penn Central Company, as successor to Pennsylvania Railroad, has been paying dividends steadily since 1848. Alas, it was doomed to bankruptcy a few months later. You'll find a company selling at only 2 times its last reported earnings, and another selling at 99 times such earnings. In most cases, you'll find it difficult to tell the line of business from the corporate name. For one U.S. Steel, there will be 3 called such things as ITI Corporation, bakery stuff, or Santa Fe Industries, mainly the large railroad. He can feast on an extraordinary variety of price histories, dividend and earnings histories, financial positions, capitalization setups, and whatnot. Backward-leaning conservatism, run-of-the-mine featureless companies, the most peculiar combinations of principal business, all kinds of Wall Street gadgets and widgets. They are all there, waiting to be browsed over, or studied with a serious objective. The guides give in separate columns the current dividend yields and price-to-earnings ratios, based on latest 12-month figures, wherever applicable. It is this last item that puts us on the track of our exercise in common stock selection. A winnowing of the stock guide. Suppose we look for a simple prima facie indication that a stock is cheap. The first such clue that comes to mind is a low price in relation to recent earnings. Let's make a preliminary list of stocks that sold at a multiple of 9 or less at the end of 1970. That datum is conveniently provided in the last column of the even-numbered pages. For an illustrative sample, we shall take the first 20 such low multiplier stocks. They begin with the 6th issue listed, Aberdeen Manufacturing Company, which closed the year at 10 1/4, or 9 times its reported earnings of $1.25 per share for the 12 months ended September 1970. The 20th such issue is American Maize Products, which closed at 9 1/2, also with a multiplier of 9. The group may have seemed mediocre, with 10 issues selling below $10 per share. This fact is not truly important. It would probably, not necessarily, warn defensive investors against such a list, but the inference for enterprising investors might be favorable on balance. Before making a further scrutiny, let us calculate some numbers. Our list represents about 1 in 10 of the first 200 issues looked at. On that basis, the guide should yield, say, 450 issues selling at multipliers under 10. This would make a goodly number of candidates for further selectivity. So let us apply to our list some additional criteria, rather similar to those we suggested for the defensive investor, but not so severe. We suggest the following. 1. Financial condition. A. Current assets at least 1.5 times current liabilities, and B. Debt not more than 110% of net current assets for industrial companies. 2. Earnings stability. No deficit in the last 5 years covered in the stock guide. 3. Dividend record. Some current dividend. 4. Earnings growth. Last year's earnings more than those of 1966. 5. Price. Less than 120% net tangible assets. The earnings figures in the guide were generally for those ending September 30th, 1970, and thus do not include what may be a bad quarter at the end of that year. But an intelligent investor can't ask for the moon, at least not to start with. Note also that we set no lower limit on the size of the enterprise. Small companies may afford enough safety if bought carefully and on a group basis. When we have applied the 5 additional criteria, our list of 20 candidates is reduced to only 5. Let us continue our search until the first 450 issues in the guide have yielded us a little portfolio of 15 stocks meeting our 6 requirements. They are set forth in Table 15.1, which can be found on the Enhancement Guide, together with some relevant data. The group, of course, is presented for illustration only and would not necessarily have been chosen by our inquiring investor. The fact is that the user of our method would have had a much wider choice. If our winnowing approach had been applied to all 4,500 companies in the stock guide, and if the ratio for the first tenth had held good throughout, we would end up with about 150 companies meeting all 6 of our criteria of selection. The enterprising investor would then be able to follow his judgment, or his partialities and prejudices, in making a third selection of, say, 1 out of 5 in this ample list. The stock guide materials includes earnings and dividend rankings, which are based on stability and growth of these factors for the past 8 years. Thus, price attractiveness does not enter here. We include the S&P rankings in our Table 15.1, which can be found on the enhancement. 10 of the 15 issues are ranked B+, equals average, and 1, American Maize, is given the high rating of A. If our enterprising investor wanted to add a 7th mechanical criterion to his choice, by considering only issues ranked by Standard & Poor's as average or better in quality, he might still have about 100 such issues to choose from. One might say that a group of issues of at least average quality, meeting criteria of financial condition as well, purchasable at a low multiplier of current earnings and below asset value, should offer good promise of satisfactory investment results. Single criteria for choosing common stocks. An inquiring listener might well ask whether the choice of a better-than-average portfolio could be made a simpler affair than we have just outlined. Could a single plausible criterion be used to good advantage, such as a low price-to-earnings ratio, or a high dividend return, or a large asset value? The 2 methods of this sort that we've found to give quite consistently good results in the longer past have been A, the purchase of low multiplier stocks of important companies, such as the DJIA list, and B, the choice of a diversified group of stocks selling under their net current asset value or working capital value. We have already pointed out that the low multiplier criterion applied to the DJIA at the end of 1968 worked out badly when the results are measured to mid-1971. The record of common stock purchases made at a price below their working capital value has no such bad mark against it. The drawback here has been the drying up of such opportunities during most of the past decade. What about other bases of choice? In writing this book, we have made a series of experiments, each based on a single, fairly obvious criterion. The data used would be readily found in the Standard & Poor's Stock Guide. In all cases, a 30-stock portfolio was assumed to have been acquired at the 1968 closing prices and then revalued at June 30, 1971. The separate criteria applied were the following, as applied to otherwise random choices. 1. A low multiplier of recent earnings, not confined to DJIA issues. 2. A high dividend return. 3. A very long dividend record. 4. A very large enterprise, as measured by number of outstanding shares. 5. A strong financial position. 6. A low price in dollars per share. 7. A low price in relation to the previous high price. 8. A high-quality ranking by Standard & Poor's. It'll be noted that the stock guide has at least one column relating to each of these criteria. This indicates the publisher's belief that each is of importance in analyzing and choosing common stocks. As we pointed out before, we should like to see another figure added, the net asset value per share. The most important fact that emerges from our various tests relates to the performance of stocks bought at random. We have tested this performance for 3 30-stock portfolios, each made up of issues found on the first line of the December 31, 1968 stock guide, and also found in the issue for August 31, 1971. Between these two dates, the S&P composite was practically unchanged, and the DJIA lost about 5%. But our 90 randomly chosen issues declined an average of 22%, not counting 19 issues that were dropped from the guide and probably showed larger losses. These comparative results undoubtedly reflect the tendency of smaller issues of inferior quality to be relatively overvalued in bull markets, and not only to suffer more serious declines than the stronger issues in the ensuing price collapse, but also to delay their full recovery, in many cases indefinitely. The moral for the intelligent investor is, of course, to avoid second-quality issues in making up a portfolio, unless, for the enterprising investor, they are demonstrable bargains. Other results gleaned from our portfolio studies may be summarized as follows. Only 3 of the groups studied showed up better than the S&P composite, and hence better than the DJIA. 1. Industrials with the highest quality ranking, A+. These advanced 9.5% in the period against a decline of 2.4% for the S&P industrials and 5.6% for the DJIA. However, the 10 public utility issues rated A+ declined 18% against a decline of 14% for the 55-stock S&P Public Utility Index. It is worth remarking that the S&P rankings showed up very well in this single test. In every case, a portfolio based on a higher ranking did better than a lower ranking portfolio. 2. Companies with more than 50 million shares outstanding showed no change on the whole, as against a small decline for the indexes. 3. Strangely enough, stocks selling at a high price per share, over 100, showed a slight 1% composite advance. Among our various tests, we made one based on book value, a figure not given in the stock guide. Here we found, contrary to our investment philosophy, that companies that combined major size with a large goodwill component in their market price did very well as a whole in the 2.5-year holding period. By goodwill component, we mean the part of the price that exceeds the book value. Our list of goodwill giants was made up of 30 issues, each of which had a goodwill component of over $1 billion, representing more than half of its market price. The total market value of these goodwill items at the end of 1968 was more than 120 billions. Despite these optimistic market valuations, the group as a whole showed a price advance per share of 15% between December 1968 and August 1971, and acquitted itself best among the 20-odd lists studied. A fact like this must not be ignored in a work on investment policies. It is clear that at the least a considerable momentum is attached to those companies that combine the virtues of great size, an excellent past record of earnings, the public's expectation of continued earnings growth in the future, and strong market action over many past years. Even if the price may appear excessive by our quantitative standards, the underlying market momentum may well carry such issues along more or less indefinitely. Naturally, this assumption does not apply to every individual issue in the category. For example, the indisputable goodwill leader, IBM, moved down from 315 to 304 in the 30-month period. It is difficult to judge to what extent the superior market action shown is due to true or objective investment merits, and to what extent to long-established popularity. No doubt both factors are important here. Clearly, both the long-term and the recent market action of the goodwill giants would recommend them for a diversified portfolio of common stocks. Our own preference, however, remains for other types that show a combination of favorable investment factors, including asset values of at least two-thirds the market price. The tests using other criteria indicate in general that random lists based on a single favorable factor did better than random lists chosen for the opposite factor. For example, low multiplier issues had a smaller decline in this period than high multiplier issues, and long-term dividend payers lost less than those that were not paying dividends at the end of 1968. To that extent, the results support our recommendation that the issues selected meet a combination of quantitative or tangible criteria. Finally, we should comment on the much poorer showing made by our lists as a whole, as compared with the price record of the S&P Composite. The latter is weighted by the size of each enterprise, whereas our tests are based on taking one share of each company. Evidently, the larger emphasis given to giant enterprises by the S&P method made a significant difference in the results, and points up once again their greater price stability as compared with run-of-the-mine companies. Bargain issues or net current asset stocks. In the tests discussed before, we did not include the results of buying 30 issues at a price less than their net current asset value. The reason was that only a handful at most of such issues would have been found in the stock guide at the end of 1968. But the picture changed in the 1970 decline, and at the low prices of that year, a goodly number of common stocks could have been bought at below their working capital value. It always seemed, and still seems, ridiculously simple to say that if one can acquire a diversified group of common stocks at a price less than the applicable net current assets alone, after deducting all prior claims and counting as zero the fixed and other assets, the result should be quite satisfactory. They were so, in our experience, for more than 30 years, say between 1923 and 1957, excluding a time of real trial in 1930 through 1932. Has this approach any relevance at the beginning of 1971? Our answer would be a qualified yes. A quick run-over of the stock guide would have uncovered some 50 or more issues that appeared to be obtainable at or below net current asset value. As might be expected, a good many of these had been doing badly in the difficult year 1970. If we eliminated those which had reported net losses in the last 12-month period, we would still be left with enough issues to make up a diversified list. We have included in Table 5.2, which can be found on the enhancement, some data on 5 issues that sold at less than their working capital value at their low prices of 1970. These give some food for reflection on the nature of stock price fluctuations. How does it come about that well-established companies, whose brands are household names all over the country, could be valued at such low figures, at the same time when other concerns, with better earnings growth of course, were selling for billions of dollars in excess of what their balance sheets showed. To quote the old days once more, the idea of goodwill as an element of intangible value was usually associated with a trade name. Names such as Lady Pepperell in sheets, Jansen in swimsuits, and Parker in pens would be considered assets of great value indeed. But now, if the market doesn't like a company, not only renowned trade names, but land, buildings, machinery, and what you will, can all count for nothing in its scales. Pascal said that the heart has its reasons that the reason doesn't understand. For heart, read Wall Street. There is another contrast that comes to mind. When the going is good and new issues are readily saleable, stock offerings of no quality at all make their appearance. They quickly find buyers. Their prices are often bid up enthusiastically right after issuance to levels in relation to assets and earnings that would put IBM, Xerox, and Polaroid to shame. Wall Street takes this madness in its stride, with no overt efforts by anyone to call a halt before the inevitable collapse in prices. The SEC can't do much more than insist on disclosure of information, about which the speculative public couldn't care less, or announce investigations and usually mild punitive actions of various sorts after the letter of the law has been clearly broken. When many of these minuscule but grossly inflated enterprises disappear from view, or nearly so, it is all taken philosophically enough as part of the game. Everybody swears off such inexcusable extravagances. Until next time. "Thanks for the lecture," says the gentle listener. "But what about your bargain issues? Can one really make money in them without taking a serious risk?" Yes, indeed. If you can find enough of them to make a diversified group, and if you don't lose patience if they fail to advance soon after you buy them. Sometimes the patience needed may appear quite considerable. In our previous edition we hazarded a single example, which was current as we wrote. It was Burton-Dixie Corporation, with stock selling at 20 against net current asset value of 30, and book value of about 50. A profit on that purchase would not have been immediate, but in August 1967, all the shareholders were offered 53 3/4 for their shares, probably at just about book value. A patient holder who had bought the shares in March 1964 at 20 would have had a profit of 165% in 3.5 years, a non-compounded annual return of 47%. Most of the bargain issues in our experience have not taken that long to show good profits, nor have they shown so high a rate. For a somewhat similar situation, current as we write, see our discussion of National Presto Industries. Special situations or workouts. Let us touch briefly on this area, since it is theoretically includable in the program of operations of an enterprising investor. It was commented upon before. Here we shall supply some examples of the genre and some further remarks on what it appears to offer an open-minded and alert investor. 3 such situations, among others, were current early in 1971, and they may be summarized as follows. Situation 1. Acquisition of Kaiser Roth by Borden's. In January 1971, Borden Incorporated announced a plan to acquire control of Kaiser Roth, diversified apparel, by giving 1 1/3 shares of its own stock in exchange for 1 share of Kaiser Roth. On the following day, in active trading, Borden closed at 26 and Kaiser Roth at 28. If an operator had bought 300 shares of Kaiser Roth and sold 400 Borden at these prices, and if the deal were later consummated on the announced terms, he would have had a profit of some 24% on the cost of his shares, less commissions and some other items. Assuming the deal had gone through in 6 months, his final profit might have been at about a 40% per annum rate. Situation 2. In November 1970, National Biscuit Company offered to buy control of Aurora Plastics Company at $11 in cash. The stock was selling at about 8.5, It closed the month at 9 and continued to sell there at year-end. Here the gross profit indicated was originally about 25%, subject to the risks of non-consummation and to the time element. Situation 3. Universal Marion Company, which had ceased its business operations, asked its shareholders to ratify dissolution of the concern. The treasurer indicated that the common stock had a book value of about $28.50 per share, a substantial part of which was in liquid form. The stock closed 1970 at $21.50, indicating a possible gross profit here if book value was realized in liquidation of more than 30%. If operations of this kind, conducted on a diversified basis for spreading the risk, could be counted to yield annual profits of, say, 20% or better, they would undoubtedly be more than merely worthwhile. Since this is not an audiobook on special situations, we are not going into the details of the business, for it really is a business. Let us point out two contradictory developments there in recent years. On the one hand, the number of deals to choose from has increased enormously, as compared with, say, 10 years ago. This is a consequence of what might be called a mania of corporations to diversify their activities through various types of acquisitions, etc. In 1970, the number of merger announcements aggregated some 5,000, down from over 6,000 in 1969. The total money values involved in these deals amounted to many, many billions. Perhaps only a small fraction of the 5,000 announcements could have presented a clear-cut opportunity for purchase of shares by a special situations man. But this fraction was still large enough to keep him busy studying, picking, and choosing. The other side of the picture is that an increasing proportion of the mergers announced failed to be consummated. In such cases, of course, the aimed-for profit is not realized, and is likely to be replaced by a more or less serious loss. Reasons for non-success are numerous, including antitrust intervention, shareholder opposition, change in market conditions, unfavorable indications from further study, inability to agree on details, and others. The trick here, of course, is to have the judgment, buttressed by experience, to pick the deals most likely to succeed, and also those which are likely to occasion the smallest loss if they fail. Further comment on the previous examples. Kaiser Roth. The directors of this company had already rejected, in January 1971, the Borden proposal when this chapter was written. If the operation had been undone immediately, the overall loss, including commissions, would have been about 12% of the cost of the Kaiser Roth shares. Aurora Plastics. Because of the bad showing of this company in 1970, the takeover terms were renegotiated and the price reduced to 10.5. The shares were paid for at the end of May. The annual rate of return realized here was about 25%. Universal Marion. This company promptly made an initial distribution in cash and stock worth about $7 per share, reducing the investment to, say, 14.5. However, the market price fell as low as 13 subsequently, casting doubt on the ultimate outcome of the liquidation. Assuming that the three examples given are fairly representative of workout or arbitrage opportunities as a whole in 1971, it is clear that they are not attractive if entered into upon a random basis. This has become more than ever a field for professionals, with the requisite experience and judgment. There is an interesting sidelight to our Kaiser Roth example. Late in 1971, the price fell below 20, while Borden was selling at 25, equivalent to 33 for Kaiser Roth under the terms of the exchange offer. It would appear that either the directors had made a great mistake in turning down that opportunity, or the shares of Kaiser Roth were now badly undervalued in the market. Something for a security analyst to look into. Commentary on Chapter 15. It is easy in the world to live after the world's opinion. It is easy in solitude to live after our own. But the great man is he who, in the midst of the crowd, keeps with perfect sweetness the independence of solitude. Ralph Waldo Emerson. Practice, practice, practice. Max Heine, founder of the Mutual Series funds, liked to say that there are many roads to Jerusalem. What this masterly stock picker meant was that his own value-centered method of selecting stocks was not the only way to be a successful investor. In this chapter, we'll look at several techniques that some of today's leading money managers use for picking stocks. First, though, it's worth repeating that for most investors, selecting individual stocks is unnecessary, if not inadvisable. The fact that most professionals do a poor job of stock picking does not mean that most amateurs can do better. The vast majority of people who try to pick stocks learn that they are not as good at it as they thought. The luckiest ones discover this early on, while the less fortunate take years to learn it. A small percentage of investors can excel at picking their own stocks. Everyone else would be better off getting help, ideally through an index fund. Graham advised investors to practice first, just as even the greatest athletes and musicians practice and rehearse before every actual performance. He suggested starting off by spending a year tracking and picking stocks, but not with real money. In Graham's day, you would have practiced using a ledger of hypothetical buys and sells on a legal pad. Nowadays, you can use portfolio trackers at websites like www.morningstar.com, http://finance.yahoo.com, http://money.cnn.com/services/portfolio/ or www.marketotracy.com. At the last site, ignore the market-beating hype on its funds and other services. By test driving your techniques before trying them with real money, you can make mistakes without incurring any actual losses, develop the discipline to avoid frequent trading, compare your approach against those of leading money managers, and learn what works for you. Best of all, tracking the outcome of all your stock picks will prevent you from forgetting that some of your hunches turn out to be stinkers. That'll force you to learn from your winners and your losers. After a year, measure your results against how you would have done if you had put all your money in an S&P 500 index fund. If you didn't enjoy the experiment, or your picks were poor, no harm done. Selecting individual stocks is not for you. Get yourself an index fund and stop wasting your time on stock picking. If you enjoyed the experiment and earned sufficiently good returns, gradually assemble a basket of stocks, but limit it to a maximum of 10% of your overall portfolio. Keep the rest in an index fund. And remember, you can always stop if it no longer interests you or your returns turn bad. Looking under the right rocks. So how should you go about looking for a potentially rewarding stock? You can use websites like http://finance.yahoo.com and www.morningstar.com to screen stocks with the statistical filters suggested in Chapter 14. Or you can take a more patient, craftsman-like approach. Unlike most people, many of the best professional investors first get interested in a company when its share price goes down, not up. Christopher Brown of Tweedy Brown Global Value Fund, William Nygren of the Oakmark Fund, Robert Rodriguez of FPA Capital Fund, and Robert Torre of the Torre Fund all suggest looking at the daily list of new 52-week lows in the Wall Street Journal, or the similar table in the Market Week section of Barron's. That'll point you towards stocks and industries that are unfashionable or unloved, and that thus offer the potential for high returns once perceptions change. Christopher Davis of the Davis Funds and William Miller of Legg Mason Value Trust like to see rising returns on invested capital, or ROIC, a way of measuring how efficiently a company generates what Warren Buffett has called owner earnings. By checking comparables or the prices at which similar businesses have been acquired over the years, managers like Oakmark's Nygren and Longleaf Partners O. Mason Hawkins get a better handle on what a company's parts are worth. For an individual investor, it's painstaking and difficult work. Start by looking at the business segment's footnote in the company's annual report, which typically lists the industrial sector, revenues, and earnings of each subsidiary. The management discussion and analysis may also be helpful. Then search a news database like Factiva, ProQuest, or LexisNexis for examples of other firms in the same industries that have recently been acquired. Using the Edgar database at www.sec.gov to locate their past annual reports, you may be able to determine the ratio of purchase price to the earnings of those acquired companies. You can then apply that ratio to estimate how much a corporate acquirer might pay for a similar division of the company you're investigating. By separately analyzing each of the company's divisions this way, you may be able to see whether they are worth more than the current stock price. Longleaf Hawkins likes to find what he calls 60-cent dollars, or companies whose stock is trading at 60% or less of the value at which he appraises the businesses. That helps provide the margin of safety that Graham insists on. Who's the boss? Finally, most leading professional investors want to see that a company is run by people who, in the words of Oakmark's William Nygren, think like owners, not just managers. Two simple tests. Are the company's financial statements easily understandable, or are they full of obfuscation? Are non-recurring or extraordinary or unusual charges just that, or do they have a nasty habit of recurring? Longleaf's Mason Hawkins looks for corporate managers who are good partners, meaning that they communicate candidly about problems, have clear plans for allocating current and future cash flow, and own sizable stakes in the company's stock, preferably through cash purchases rather than through grants of options. But if managements talk more about the stock price than about the business, warns Robert Torrey of the Torrey Fund, we're not interested. Christopher Davis of the Davis Funds favors firms that limit issuance of stock options to roughly 3% of shares outstanding. At Vanguard PrimeCap Fund, Howard's Cho tracks what the company said one year and what happened the next. We want to see not only whether managements are honest with shareholders, but also whether they're honest with themselves. If a company boss insists that all is hunky-dory when business is sputtering, watch out. Nowadays, you can listen in on a company's regularly scheduled conference calls, even if you own only a few shares. To find out the schedule, call the Investor Relations Department at corporate headquarters or visit the company's website. Robert Rodriguez of FPA Capital Fund turns to the back page of the company's annual report, where the heads of its operating divisions are listed. If there's a lot of turnover in those names in the first 1 or 2 years of a new CEO's regime, that's probably a good sign. He's cleaning out the dead wood. But if high turnover continues, the turnaround has probably devolved into turmoil. Keeping your eyes on the road. There are even more roads to Jerusalem than these. Some leading portfolio managers, like David Dremen of Dremen Value Management and Martin Whitman of the Third Avenue Funds, focus on companies selling at very low multiples of assets, earnings, or cash flow. Others, like Charles Royce of the Royce Funds and Joel Tillinghast of Fidelity Low-Priced Stock Fund, hunt for undervalued small companies. And for an all-too-brief look at how today's most revered investor, Warren Buffett, selects companies, see the sidebar on page 401. One technique that can be helpful: see which leading professional money managers own the same stocks you do. If 1 or 2 names keep turning up, go to the websites of those fund companies and download their most recent reports. By seeing which other stocks these investors own, you can learn more about what qualities they have in common. By reading the manager's commentary, you may get ideas on how to improve your own approach. No matter which techniques they use in picking stocks, successful investing professionals have 2 things in common. First, they are disciplined and consistent, refusing to change their approach even when it's unfashionable. Second, they think a great deal about what they do and how to do it, but they pay very little attention to what the market is doing. From EPS to ROIC. Net income or earnings per share, EPS, has been distorted in recent years by factors like stock option grants and accounting gains and charges. To see how much a company is truly earning on the capital it deploys in its businesses, look beyond EPS to ROIC, or return on invested capital. Christopher Davis of the Davis Funds defines it with this formula. ROIC equals owner earnings divided by invested capital, where owner earnings is equal to operating profit plus depreciation plus amortization of goodwill, minus federal income tax paid at the company's average rate, minus cost of stock options, minus maintenance or essential capital expenditures, minus any income generated by unsustainable rates of return on pension funds, as of 2003, anything greater than 6.5%. And where invested capital is equal to total assets minus cash, as well as short-term investments and non-interest-bearing current liabilities, plus past accounting charges that reduced invested capital. ROIC has the virtue of showing, after all legitimate expenses, what the company earns from its operating businesses, and how efficiently it has used the shareholders' money to generate that return. An ROIC of at least 10% is attractive. Even 6% or 7% can be tempting if the company has good brand names, focused management, or is under a temporary cloud. Warren's Way. Graham's greatest student, Warren Buffett, has become the world's most successful investor by putting new twists on Graham's ideas. Buffett and his partner Charles Munger have combined Graham's margin of safety and detachment from the market with their own innovative emphasis on future growth. Here is an all-too-brief summary of Buffett's approach. He looks for what he calls franchise companies with strong consumer brands, easily understandable businesses, robust financial health, and near monopolies in their markets, like H&R Block, Gillette, and the Washington Post Company. Buffett likes to snap up a stock when a scandal, big loss, or other bad news passes over it like a storm cloud, as when he bought Coca-Cola soon after its disastrous rollout of New Coke and the market crash of 1987. He also wants to see managers who set and meet realistic goals, build their businesses from within rather than through acquisition, allocate capital wisely, and do not pay themselves $100 million jackpots of stock options. Buffett insists on steady and sustainable growth in earnings, so the company will be worth more in the future than it is today. In his annual reports, archived at www.berkshirehathaway.com, Buffett has set out his thinking like an open book. Probably no other investor, Graham included, has publicly revealed more about his approach or written such compellingly readable essays. One classic Buffett proverb: when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. Every intelligent investor can and should learn by reading this master's own words. Chapter 16. Convertible Issues and Warrants. Convertible bonds and preferred stocks have been taking on a predominant importance in recent years in the field of senior financing. As a parallel development, stock option warrants, which are long-term rights to buy common shares at stipulated prices, have become more and more numerous. More than half the preferred issues now quoted in the Standard & Poor's Stock Guide have conversion privileges, and this has been true also of a major part of the corporate bond financing in 1968 through 1970. There are at least 60 different series of stock option warrants dealt in on the American Stock Exchange. In 1970, for the first time in its history, the New York Stock Exchange listed an issue of long-term warrants, giving rights to buy 31,400,000 American Tel & Tel shares at $52 each. with Mother Bell now leading that procession, it is bound to be augmented by many new fabricators of warrants. As we shall point out later, they are a fabrication in more than one sense. In the overall picture, the convertible issues rank as much more important than the warrants, and we shall discuss them first. There are two main aspects to be considered from the standpoint of the investor. First, how do they rank as investment opportunities and risks? Second, how does their existence affect the value of the related common stock issues? Convertible issues are claimed to be especially advantageous to both the investor and the issuing corporation. The investor receives the superior protection of a bond or preferred stock, plus the opportunity to participate in any substantial rise in the value of the common stock. The issuer is able to raise capital at a moderate interest or preferred dividend cost, and if the expected prosperity materializes, the issuer will get rid of the senior obligation by having it exchanged into common stock. Thus, both sides to the bargain will fare unusually well. Obviously, the foregoing paragraph must overstate the case somewhere, for you cannot, by a mere ingenious device, make a bargain much better for both sides. In exchange for the conversion privilege, the investor usually gives up something important in quality or yield, or both. Conversely, if the company gets its money at lower cost because of the conversion feature, it is surrendering in return part of the common shareholders' claim to future enhancement. On this subject, there are a number of tricky arguments to be advanced both pro and con. The safest conclusion that can be reached is that convertible issues are like any other form of security, and that their form itself guarantees neither attractiveness nor unattractiveness. That question will depend on all the facts surrounding the individual issue. We do know, however, that a group of convertible issues floated during the latter part of a bull market are bound to yield unsatisfactory results as a whole. It is at such optimistic periods, unfortunately, that most of the convertible financing has been done in the past. The poor consequences must be inevitable from the timing itself, since a wide decline in the stock market must invariably make the conversion privilege much less attractive, and often also call into question the underlying safety of the issue itself. As a group illustration, we shall retain the example used in our first edition of the relative price behavior of convertible and straight, non-convertible preferreds offered in 1946, the closing year of the bull market preceding the extraordinary one that began in 1949. A comparable presentation is difficult to make for the years 1967 through 1970. Because there were virtually no new offerings of non-convertibles in those years. But it is easy to demonstrate that the average price decline of convertible preferred stocks from December 1967 to December 1970 was greater than that for common stocks as a whole, which lost only 5%. Also, the convertibles seem to have done quite a bit worse than the older straight preferred shares during the period December 1968 to December 1970. As is shown by the sample of 20 issues of each kind in Table 16.2, which can be found on the enhancement. These comparisons would demonstrate that convertible securities as a whole have relatively poor quality as senior issues, and also are tied to common stocks that do worse than the general market, except during a speculative upsurge. These observations do not apply to all convertible issues, of course. In the 1968 and 1969 particularly, a fair number of strong companies used convertible issues to combat the inordinately high interest rates for even first-quality bonds. But it is noteworthy that in our 20-stock sample of convertible preferreds, only one showed an advance, and 14 suffered bad declines. The conclusion to be drawn from these figures is not that convertible issues are in themselves less desirable than non-convertible or straight securities. Other things being equal, the opposite is true. But we clearly see that other things are not equal in practice, and that the addition of the conversion privilege often, perhaps generally, betrays an absence of genuine investment quality for the issue. It is true, of course, that a convertible preferred is safer than the common stock of the same company. That is to say, it carries smaller risk of eventual loss of principal. Consequently, those who buy new convertibles instead of the corresponding common stock are logical to that extent. But in most cases, the common would not have been an intelligent purchase to begin with, at a ruling price, and the substitution of the convertible preferred did not improve the picture sufficiently. Furthermore, a good deal of the buying of convertibles was done by investors who had no special interest or confidence in the common stock. That is, they would never have thought of buying the common at the time, but who were tempted by what seemed an ideal combination of a prior claim plus a conversion privilege close to the current market. In a number of instances, this combination has worked out well, but the statistics seem to show that it is more likely to prove a pitfall. In connection with the ownership of convertibles, there is a special problem which most investors fail to realize. Even when a profit appears, it brings a dilemma with it. Should the holder sell on a small rise? Should he hold for a much bigger advance? If the issue is called, as often happens when the common has gone up considerably, should he sell out then, or convert into and retain the common stock? Let us talk in concrete terms. You buy a 6% bond at 100, convertible into stock at 25, that is, at the rate of 40 shares for each $1,000 bond. The stock goes to 30, which makes the bond worth at least 120, and so it sells at 125. You either sell or hold. If you hold, hoping for a higher price, you are pretty much in the position of a common shareholder, since if the stock goes down, your bond will go down too. A conservative person is likely to say that beyond 125, his position has become too speculative, and therefore he sells and makes a gratifying 25% profit. So far, so good. But pursue the matter a bit. In many cases where the holder sells at 125, the common stock continues to advance, carrying the convertible with it, and the investor experiences that peculiar pain that comes to the man who is sold out much too soon. The next time he decides to hold for 150 or 200. The issue goes up to 140 and he does not sell. Then the market breaks and his bond slides down to 80. Again, he has done the wrong thing. Aside from the mental anguish involved in making these bad guesses, and they seem to be almost inevitable, there is a real arithmetical drawback to operations in convertible issues. It may be assumed that a stern and uniform policy of selling at 25% or 30% profit will work out best as applied to many holdings. This would then mark the upper limit of profit and would be realized only on the issues that worked out well. But if, as appears to be true, these issues often lack adequate underlying security and tend to be floated and purchased in the latter stages of a bull market, then a goodly proportion of them will fail to rise to 125, but will not fail to collapse when the market turns downward. Thus, the spectacular opportunities in convertibles prove to be illusory in practice, and the overall experience is marked by fully as many substantial losses, at least of a temporary kind, as there are gains of similar magnitude. Because of the extraordinary length of the 1950 through 1968 bull market, convertible issues as a whole gave a good account of themselves for some 18 years. But this meant only that the great majority of common stocks enjoyed large advances, in which most convertible issues were able to share. The soundness of investment in convertible issues can only be tested by their performance in a declining stock market, and this has always proved disappointing as a whole. In our first edition, 1949, we gave an illustration of this special problem of what to do with a convertible when it goes up. We believe it still merits inclusion here. Like several of our references, it is based on our own investment operations. We were members of a select group, mainly of investment funds, who participated in a private offering of convertible 4.5% debentures of Eversharp Company at par, convertible into common stock at $40 per share. The stock advanced rapidly to 65.5, and then, after a 3-for-2 split, to the equivalent of 88. The latter price made the convertible debentures worth no less than $220. During this period, the two issues were called at a small premium. Hence, they were practically all converted into common stock, which was retained by a number of the original investment fund buyers of the debentures. The price promptly began a severe decline, and in March 1948, the stock sold as low as 7 3/8. This represented a value of only 27 for the debenture issues, or a loss of 75% of the original price, instead of a profit of over 100%. The real point of this story is that some of the original purchasers converted their bonds into the stock and held the stock through its great decline. In so doing, they ran counter to an old maxim of Wall Street, which runs, "Never convert a convertible bond." Why this advice? Because once you convert, you've lost your strategic combination of prior claimant to interest, plus a chance for an attractive profit. You've probably turned from investor into speculator, and quite often at an unpropitious time, because the stock has already had a large advance. If never convert a convertible is a good rule, how came it that these experienced fund managers exchanged their ever-sharp bonds for stock, to their subsequent embarrassing loss? The answer, no doubt, is that they let themselves be carried away by enthusiasm for the company's prospects, as well as by the favorable market action of the shares. Wall Street has a few prudent principles. The trouble is that they're always forgotten when they're most needed. Hence that other famous dictum of the old-timers: "Do as I say, not as I do." Our general attitude toward new convertible issues is thus a mistrustful one. We mean here, as in other similar observations, that the investor should look more than twice before he buys them. After such hostile scrutiny, he may find some exceptional offerings that are too good to refuse. The ideal combination, of course, is a strongly secured convertible, exchangeable for a common stock, which itself is attractive, and at a price only slightly higher than the current market. Every now and then a new offering appears that meets these requirements. By the nature of the securities markets, however, you're more likely to find such an opportunity in some older issue which is developed into a favorable position, rather than in a new flotation. If a new issue is a really strong one, it is not likely to have a good conversion privilege. The fine balance between what is given and what is withheld in a standard-type convertible issue is well illustrated by the extensive use of this type of security in the financing of American Telephone and Telegraph Company. Between 1913 and 1957, the company sold at least 9 separate issues of convertible bonds, most of them through subscription rights to shareholders. The convertible bonds had the important advantage to the company of bringing in a much wider class of buyers than would have been available for a stock offering, since the bonds were popular with many financial